Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. This week on the podcast, I shall be discussing the equity markets of two contrasting countries. One with a population of 100 million, the other a population of 70 million. One, a single-party, communist-controlled state, and the other, one of the oldest democracies in the world. I'm talking here about Vietnam and the UK. Which of the two do you think has had the better performance record over the last 30 years? Well, I don't think it's a total surprise to say that it's Vietnam, but what are the prospects from here? I shall be discussing the outlook for both these two equity markets with Dominic Scriven, the founder of Dragon Capital, which is also the founder and manager of Vietnam Enterprise Investment Trust, ticker VEIL, founded 1995. And Ian Lance, the co-manager of Temple Bar Investment Trust, a UK equity income vehicle that was IPO'd in 1926. Two very contrasting stories, but both markets where you can argue there is scope for a catalyst for a re-rating coming up in the next few months or years. More on that in a moment. It's been a week in which the headlines have, naturally enough, been dominated by the ongoing crisis in the Middle East, following Iran's missile and drone assault on Israel last weekend and the response from Israel which came on Friday this week. As it happens, amidst a lot of tension, fears that the situation would escalate dramatically and quickly appear to have receded somewhat over the course of the week, with many of Israel's diplomatic partners urging caution. In the event, it's not total surprise that the markets have gone into a risk-off mode. Equity markets generally have had a poor week, with the world index down 3%, and the US market, as represented by the S&P 500, down similarly 3%, and Nasdaq down even more by 5%. Japanese market also off by more than 5%. So it's not been without incident, but against this background, the UK market has performed relatively well. The all-share index down around 1.3%. Gilts, however, there was continued pressure on yields, with prices falling across most of the maturity spectrum in the gilts market, and similarly rises in bond yields in the US as well. And at the same time, gold continues its strong run, touching $2,400 at one stage. That's a new high, whereas oil prices actually eased a little over the course of the week. So it's been an interesting week and not a particularly positive one for risk assets, as you might expect. The UK inflation figures also came out, and while they showed a decline in headline terms, there were some aspects of the figures which were concerning, notably the continued strength of wages and service inflation, both rising around 6%. The inflation figures should come down next month because of technical factors associated with the change in the energy price cap regime. But as yet, there's no indication that interest rate cuts are imminent while still being on the table for consideration by central banks. Turning to the investment trust market, the investment trust index was down just around 1.1%, so somewhat less than the all-share and the world indices. So that was, I guess, encouraging, but the number of gainers was outnumbered by losers by around 4-1. Top of the performers this week was Hypnosis Songs Fund, ticker SONG, where the trust has received a bid from an American company, the one that formerly took over the assets of Round Hill Music not so long ago. And this offer has come in at around $1.13, which equates to about 92 pence in sterling terms. That's a significant premium over the recent share price. So the top performer of the week, this trust, up around 24%. That may be a relief for the shareholders who've had a torrid time in the recent months. The share price that's been offered by the American bidder is below the issue price at which Song came to market back in 2018, But allowing for the dividends that it paid until recently, the total return from an investment in Song, if you'd held it since launch, will turn out to be around 11%, pretty modest in the circumstances for 6 years of very interesting times. Of course, there may still be a rival bidder. The management company led by Mercuriadis, who founded Hypnosis Songs, has the right to match that bid. But so far, at least, it is positive news there. Elsewhere, we only had a handful of results, half a dozen companies reporting full-year results. We're pretty much through the annual reporting season now, except for some of the alternatives. There were good performances from Fair Oak Income, the debt fund, which has reported a 13% NAV total return, and likewise a double-digit return from Schroeder Japan, up 10.3% or so. There were also results from UK Commercial Property, ticker UKCM, up 3%, from Hydrogen One, the specialist hydrogen trust, which has reported NAV total return of 6%, and not such good figures, minus figures from Middlefield Canadian Income and Castlenow Group, both of them down by a small percentage in NAV total return terms. Elsewhere in the news, apart from the bid for Hypnosis Songs, we heard that Balanced Commercial Property Trust, ticker BCPT, is launching a strategic review. And also, the news came out that Alliance Trust, ticker ATST, which runs a multi-manager strategy, has dropped Jupiter as one of the managers it employs, following the decision of Ben Whitmore, who manages its Equity Income Trust, to leave Jupiter and set up his own boutique investment firm. The mandate has been given to another firm that has a strict value investment style called Agra. And we also heard from the board of Home REIT, which confirmed that it has started litigation against the former advisors to the trust, and it is also defending itself against a letter of claim from disgruntled shareholders who claim that they were misled by the promises and the prospectus that Home REIT offered when it came to the market. And of course now the shares there are still suspended. It's not been a happy story. There have also been interesting announcements this week from Harmony Energy Income, ticker HEIT, and Gresham House Energy Storage, ticker GRID, which has not only cut its dividend following a collapse in revenues, but also is stopping its share buyback program in order to preserve cash. Plus updates from Ashoka India Equity, Invesco Select, AEET, Aquila Energy Efficiency, which is launching a tender offer, and Next Energy Solar. All this and more is summarized in our weekly email. In the Moneymakers Circle this week, our latest profile features STS Global Income and Growth, ticker STS, formerly known as Securities Trust of Scotland, and now managed by Troy Asset Management. And that will be followed in coming weeks by profiles of Artemis Alpha, ticker ATS, VH Global Sustainable Energy Opportunities, ticker GSEO, and Henderson High Income, ticker HHI. A reminder that our profiles are entirely independent and are intended to provide an in-depth analysis of the history and performance of the trusts in question. At the same time, in our weekly email, we have our normal summary of all the week's news and the biggest movers in NAV, share price, and discount terms. This week also, I offer some thoughts on the most recent news coming out of the sector, including that bid for Hypnosis and one or two other items. The weekly email that we send out to subscribers normally goes out either late on Friday or early on Saturday morning ahead of the podcast, and I hope you'll agree provides a comprehensive summary of all the things that are going on in the investment trust sector. This week, then, I had the opportunity to have a conversation with Dominic Scriven, who is the founder and chairman of Dragon Capital, which in turn is the investment advisor to Vietnam Enterprise Investment Trust, ticker VEIL. It was set up in 1995 originally, and currently has a market capitalization well in excess of 1 billion sterling, making it about the 40th largest investment trust in the UK. So, Dominic, you've been doing this for an awfully long time. Perhaps it's no harm in actually asking you to recap how you actually came to set up this company, which specializes in Vietnam, why you think it's a great country and why you've lived there and learnt the language there and so on, and been doing this now for more than 30 years.
Yeah, hi, Jonathan. Thank you for your time and hello to your listeners. I first went to Vietnam on a sort of market discovery trip in 1990, and I was very struck by the country because In those days, pretty much everywhere in Asia was beginning to boom, and there were lots of interconnections, economic, financial, developmental, trade, investment connections. And Vietnam struck me as being alone in the sense that it had no real friends apart from the old Soviet Union. Relations were a bit frosty with China in those days. And I happened to want to learn a tonal language, which is a language where the meaning of a word comes from a picture rather than from a sound. And there aren't very many places in the world where you can do that. Obviously, China is the main one, but also Vietnamese is a tonal language. So I went to university in Hanoi for a couple of years in the early 90s and learned Vietnamese and then ran out of money. And I had a little background in investment. And together with some mates, we thought we'd have a go. And we set up Bail, as you rightly named it, in 1995, $16.39 million, subscribed by a range of somewhat pioneering investment institutions of the day. And we've kept at it, not really believing that we would keep at it, perhaps in some senses, but being fascinated by the journey, being challenged by the journey. And Bail, as you rightly point out, coming up to 30 years. If the skies allow us, the universe permits us, we'll keep going for another 30 for sure, because the development story of Vietnam is remarkable, particularly for people of my generation. I would have been too young to do anything other than study in the 70s, but the whole era of Vietnam is marked on the Western conscience, I think, as an overstep. And, probably in some subliminal way, that's why I first went to Vietnam. But now the story is completely different. Tim Cook, CEO of Apple, is in Hanoi today, having a bowl of noodle soup and working out exactly what Apple's plans are in Vietnam. And I think next month, Jensen Huang from NVIDIA is on his way back. And this sort of excitement about semiconductors is really what's come from a remarkable diplomatic year of Vietnam in 2023, when both Joe Biden and Xi Jinping, the number one equal, shall we say, in the world's geopolitical sphere, both paid visits to Vietnam. And Joe Biden oversaw a significant upgrade in the diplomatic relationship between two parties. And leaving aside the politics and the geopolitics and all that stuff, really there's a lot of focus on global supply chains. And this has been underway since SARS in 2003, when the global textile industry realized that all its eggs were in one basket. And so there was this China plus one theme developed. And so, it's not a new thing, but it's been developing in stages. And foreign investment in Vietnam is consistently above 5% of GDP, which is a very large number. In fact, there's no other country anywhere in Asia which gets more than 5% of GDP. And I don't know the numbers from Mexico and Poland, but, it's punching high.
Well, as you've alluded to, it has been a remarkable journey by Vietnam. I think I saw it described by the World Bank or some equivalent as being the most capitalistic, communist-run country in the world. It's still a communist-run country, but the economy has been growing very fast, as you say, following the same track as China and other countries, Korea and so on. So I guess the first question then has to be, although it's a very capitalistic sort of country, the way it runs its economy, there are still a lot of restrictions. The government is still quite heavily involved in managing the economy. And in particular, the stock market, while it's open to foreign investors, there's still restrictions, are there not, on how much money can be invested in some of the core companies in the country?
Yeah, that is true. So for any of your listeners who've studied Asia, the idea of restricting foreign ownership flows, capital flows into public markets won't be new. I mean, of course, Japan set the theme, and in fact, Korea, Taiwan, and all of Southeast Asia as well. And it's a process of maturing, I think, where countries initially open their capital accounts with some controls. And over time, as the ability of the financial system and also the governance system and the market structure grows, then these restrictions tend to fade away. And I'm sure that's what will happen in Vietnam. At the moment, to give an idea, GDP is just short of $500 billion. The equity market's about $250 billion. The government is indeed the largest investor with probably about $50 billion, maybe a bit more than that. We're the second biggest investor, actually, Dragon, after the government with $6 billion. And we don't really have an enormous problem finding companies to invest in, but it is, as you rightly allude, an issue that some people pay attention to. So broadly speaking, 30% of financial institutions, 49% of all non-financial companies are the limits at which foreign investors can buy. In fact, there are about 1,500 companies listed, and I think only 20 are at the limits at which it becomes more problematic for foreigners to invest in. But those are 20 companies that people like. So I would say the foreign ownership limits is not a major obstacle in their own right, but they are indicative of why Vietnam is viewed by many still as a frontier market rather than an emerging market. Of course, in terms of its size, its turnover, the punch that Vietnam wields in the global markets, it's not yet been acknowledged to be an emerging market per se. And foreign ownership limits is one of those issues. Also, the ability of foreign investors to invest conventionally, by which I mean in Vietnam, all investors are expected to put their money down on the table first, to pre-fund, as it's called. And this does mean that the structure of the market is very sound. We've never had a failed trade in 25 years, but it's something that slightly irritates some of the big global institutions. And of course, all of these issues, in a way, are why we still have a job, because we're on the ground. We've got 200 people in Dragon, and we're on the ground, and we engage with the regulators, engage with the exchange, engage with the depository. So we can engage with companies, of course, so we can manage a lot of these points of friction.
I have read there's a lot of interest in whether or not Vietnam will become part of the emerging markets formally, stop being a frontier market. I see in your presentation, you say that Vietnam will become a larger consumer market than the UK at one stage, not too long. It has a population which is already 100 million. So what is the attitude of the authorities? Are they not too concerned about whether or not they have emerging market status?
No, I think they're very concerned to raise the bar. Vietnam is an ambitious country. Let us definitely remember that. And they benchmark themselves against what's called the ASEAN 4, which is 4 sizable ASEAN economies: Philippines, Indonesia, Thailand, and Malaysia. And in the time that we've been at work, Vietnam's been climbing up the ranks, and I think is now ahead of Philippines and closing in on Indonesia in terms of GDP per capita metrics and stuff like that. And there's no question that everyone, in fact, the Prime Minister himself, just a couple of months ago at a forum, was very clear that Vietnam has clear ambitions to become an emerging market. One point of consideration, which is not small in my mind, is next year, 2025, is 50 years of modern Vietnam, 50 years after 1975, when the country was unified. And so most government agencies are hard at work picking key performance indicators and metrics with which they can mark this significant year. And in the area of markets, stock markets, capital markets in general, this would be unquestionably the marker. So the chairwoman of the State Securities Commission, which is the regulator that we have, is deeply engaged in a process. I'll spare you the intricate details, but suffice to say that they have drafted regulations to tackle the principal obstacles. And there's no question in our mind that Vietnam will become an emerging market. It's more a question of when. And we have been wrong on calling the time on this, so I'm not going to speculate and run the risk of being wrong again. Safe to say that 2025 is a big year in many, many people's minds.
You started this whole venture back in the 1990s when single country funds were very much the kind of flavor of the month. A lot of people started single country funds. Since then, we've seen a sort of general trend where a lot of those single country funds have become less a focus of a way for people to invest. What is so special about Vietnam that you would want to reserve a place in your portfolio for this particular country?
Well, there's a couple of features. One feature which we have addressed is that the structure of investment trusts, I think you pointed they go in favor and out of favor. The structure of investment trusts with their periodic review of relevance, in particular in continuation votes, is an extremely useful tool. We have a continuation vote every 5 years. And about year 3, me and my colleagues wake up sweating in the middle of the night, going, how on earth can we improve the proposition? So there's this very regular structural component of investment trusts that keeps people focused and keeps people clean. And I think it's a good management tool, notwithstanding the fact that sometimes we wake up in the middle of the night. But that's a comment on trusts generally. A comment on Vietnam would be that there's a low degree of institutionalization. And this is something you find quite often in developing countries, developing markets, is that initially the bulk of of activity is on behalf of individual investors. And so, first of all, markets tend to be a bit more volatile. In fact, Vietnam is the most volatile stock market in Southeast Asia, both on the way up and on the way down, I would add. So it works both ways, of course. But one of the principal reasons is the absence of institutions, the absence of mutual funds, the absence of structured products, the absence of pension funds. In fact, not to blow our own trumpet, but Dragon was the first licensed pension fund manager in Vietnam. There's a small and somewhat troubled state-owned pension scheme, and we were the first of the non-state players. There are now four, but the total AUM of pension funds, ours and others in Vietnam, is less than $10 million. So the stock market capitalization of $250 billion and pension funds of only $10 million gives you an idea of how desperately needed are institutions, professional investors, people who focus on investing as their job. If we look at what's ahead in Vietnam, there are two angles. There's the macro angle, and then there's the market angle. So it's a good question. Do good GDP numbers always turn up in investment returns?
I'd say no, by the way.
Yeah, well, it depends, doesn't it? Absolutely depends. It depends on things like the structure of the financial sector, on consistency of decision making, on the cost of capital, et cetera, et cetera. So Vietnam's had GDP growth of 6 to 6.5% for 30 years. And returns available, for example, have been 10 to 12% a year for 30 years. So there's not like startling, but that's not at all bad. And it shows you that investment returns are higher than GDP growth. And I would suggest that that's likely to continue in the future because the structure of the economy and the political system that oversees that economy are unlikely to change. And indeed, factors outside Vietnam continue to sort of favor Vietnam's strong points. Most obviously, Tim Cook and Apple and the global supply chain, for example, which is happening on a daily basis. But moving from there to the question of, is it going to be a good investment, leaving aside the past? There are two factors that I think are unavoidable, actually. I think anybody who visits Vietnam would come to the same conclusion. The first, which we touched on, is promoting Vietnam from its lowly state as a frontier market. It is the biggest of the frontier markets. It's 30% of the frontier market index, which is a sort of unwieldy number, really, and doesn't do Vietnam any favors. And that promotion, as and when it comes, will bring significant capital flows. The World Bank has estimated that Vietnam's promotion of capital markets and increase to emerging market status could bring $50 billion in capital. Well, that's 20% of market cap. That's a vast number. And of course, it wouldn't come at once, but this will happen. And instead of people who invest in Vietnam as a career risk, it'll be something that people need to take seriously. That's an unavoidable truth of the investment industry. The second, and probably more interesting feature, I think, in developmental terms, is the growth of the Vietnamese investor base. So, as you pointed out, Jonathan, Vietnam's 100 million people. It was 66 million people when we started, and the population's growing about 1 million a year. But when you think of that, it's a country the size of Thailand that's rural, and a population the size of Malaysia that's urban. And the urban one is growing quicker than the rural one, of course, because people are leaving the countryside and moving to the cities. Vietnam is still only about less than 40% urbanized. But within this urban population, you get much higher rates of economic growth, much greater productivity, savings, and the need for investments. And this is driven really by GDP per capita. And most analyses would say somewhere around $8,000 to $10,000 a person is where people have enough money in the banks. The deposit rates in the banks are no longer high because there's a surplus of savings. And people need to have investment. And in Ho Chi Minh City, in much of the urban economy of Vietnam, that's roughly 40 million people. We are at those levels already. And so the growth of domestic investors is beginning to increase. Pre-COVID, there were 2 million securities accounts. There are now 7 million, growing something like 50 to 100,000 new accounts every month. But that is still, if we say 7 million accounts, it's not quite one account per person because some people have many accounts, but there's an urban population of 7 million people and less than 20% of them would have accounts. And you can look at Korea, Taiwan, Thailand, or even China, and you can see exactly the same demographic trends occurring. Now, the point of these two, emerging market and domestic investor elements, is that they increase the flows of capital, they increase the maturity, they increase the professionalization, and they increase the valuation of companies. Or to put it another way, they reduce the cost of capital to companies, both in terms of equity and in terms of debt. And that has this virtuous circle impact of companies accessing lower cost capital, increasing their profitability, increasing their ROEs, which in turn makes them more interesting as investment places. There's more flows, and so the valuations go higher. And sort of all of these things that we're talking about here are not new only in the case of Vietnam. They have been abundantly evidenced in other markets, not least in Asia itself. And so, much of what we do at Dragon is not be rocket scientists. We follow the notion of in the land of the blind, the one-eyed is king. And we just try and work out what lessons have worked elsewhere and then try and apply them in Vietnam and sort of manage out the risks. I think the macro story of Vietnam possibly doesn't need huge storytelling because it is quite widely known now. I think the success of Vietnam, its demographics, its political stability, income growth, supply chain issues, not least tourism, of course, all of these positive drivers. And then we've talked a little bit about the markets and in particular the medium term. I mean, I suppose I'm looking to sort of 2030, the drivers to 2030 and 2035 of what's going to drive investment returns. So I think Vietnam, it's attractive, but I think it's also going to become probably the most significant capital market in Southeast Asia long term. When we look at the alternatives, of course, Indonesia is a vastly bigger country. But if you look at the Indonesian economic model, it's very, very internal. Indonesia is low trader, low investor, low position in the global supply chain. Of course, that's because it can afford not to, because Indonesia is so rich in resources. But that's also true, that factors into its capital markets as well. So, I think by the time we get to 2030, Vietnam's going to be very prominent in Southeast Asia.
So before we just move on to talk about the trust a little bit more, then just tell me about the risks. As we know, there's volatility in the stock market, but there's also some broader risks I suppose one should think about. One is there might be some lingering fears among some people about the role of the government, but more generally, perhaps there's also some geopolitical risk, is there? I mean, if we were to see some kind of geopolitical crisis in Asia, presumably the Vietnamese would be more aligned with the Chinese than they were with the Americans, so put it that way, if it came to that kind of showdown. How would you reassure investors that there isn't some geopolitical risk lurking there, to the extent one can?
Yeah, I'd say spot on, Jonathan. That's intellectually, and I suppose in investment terms, an extremely interesting question, isn't it? At the moment, and I don't think anybody really should crow about this, but Vietnam is a superb beneficiary of the geopolitical situation. It is close to China. And as you've noted, there are strong cultural, historical, and contemporary political links between the two countries. So they understand each other better. In fact, I think, if you were to ask a Chinese person, who do you understand next best other than Chinese people? I think they would say Vietnamese people. A high degree of comfort. At the same time, you've got this remarkable historical relationship with the United States. That means that for the United States, Vietnam is for many reasons, a sort of premium political target in Asia. Of course, I did mention this has been happening since 2003, right? But you're quite right to raise the point because since Trump, in essence, or maybe even since Obama, it's become a little clearer. And at the moment, over the last few years, Vietnam's been running a stocking great trade deficit with China, like a $40 billion, $50 billion trade deficit with China, which is its largest trading partner. It's also been running a stocking great trade surplus with the United States, which last year was $80 billion. And the United States is Vietnam's second biggest trading partner. And at the moment, everybody seems to be quite comfortable with that. But, the question, and this is not just a question for Vietnam, actually, it's a question throughout Asia. I've heard people in Singapore say, we'll be okay so long as we're not forced to choose. And I think that's the question for us all and for your listeners to focus on is it possible that in the coming 10 to 20 years, we'll all be forced to choose. And the absolute central point of Vietnam's foreign policy is to not be asked that question. So before anyone visits, be it Xi Jinping or President Biden, it's made very clear that that question is not for discussion. And in fact, Vietnam's coined the term bamboo diplomacy. So your roots are extremely solid, but you have some flexibility with the wind. And of course, we know bamboo structurally is stronger than steel. So let's hope they keep at it. But if I could, you talk about risks. It's not risk-free, of course, no. And you rightly reminded listeners that Vietnam is a volatile market. So typically, we do not suggest that investors approach Vietnam with a short-term mindset. In fact, the mandate for Vail, our investment trust, is a 3-year rolling index comparator. 3 years, not 1 year. And so volatility is one. I think there are some other risks, governance. This is a global feature, of course, but it's definitely a feature in Vietnam. Not that people are crooks, let me hasten to add. It's more a case of the maturing. So, for example, most companies are less than 30 years old. They may have been state enterprises before they were privatized. It's one interesting entry to the market, or they're private sector companies. Indeed, rather like we're Dragon, frankly, we're 30 years old. And we started the same time as many Vietnamese companies. But what happens there is we don't have the many years, decades, centuries of history, such as we have in this country, Britain, or other jurisdictions in the world, where notions of succession, notions of stakeholder interests, notions of disclosure of information, what sort of penalties, institutions, all this sort of stuff in markets. So that's why we have 200 people, frankly, is because there's an awful lot of engagement with lots of different parts of the market, and being able to avoid pitfalls, be they companies or sectors or groups of shareholders or whatever, is extremely important. So, often one says, well, in a place like Vietnam where you've got such strong growth, really what you want to do is to focus on what could go wrong, because the returns will naturally occur. What upsets most people is where they make mistakes from which they can't recover. And governance is a very good example of this, I would say. In fact, it's probably the biggest determinant of positive or negative returns, I think. And so getting that right is very important, yeah. You talk about the political system. It's interesting, isn't it? You make the point, Jonathan, that Vietnam's run by a communist party. And of course, in the West, we sometimes confuse politics and economics. So communism essentially is a political system. It's a system of political control. Now, right, Leninism and Maoism, they're systems of control. They're not so much now systems of economic management. But of course, they're different to what we know in the West. And so understanding is crucial. In Vietnam, the Communist Party is the only political party. About 8% of the country's population are members. So in some sense, it is a sort of elite. And, the political system runs with a 5-year cycle. So every 5 years, there's a succession process. And because there's one party and there's not a lot of public debate, typically we tend not to know the real interior goings on. So that leads to speculation and uncertainty, etc. But, and here's the key point, the reason that there is only one party is because the interests of the country have been determined to be maintenance of stability. And it's been determined that stability is best delivered by one monolithic party. And so in that potential instability is actually a source of stability. And I would caveat that, of course, to the point we discussed earlier, which is Vietnam going to continue its current geopolitical trajectory? We're betting our future on the fact that it is. Let me move from that question of political stability to monetary and financial, because as you alluded, good GDP growth numbers don't always end up in good returns. And to me, the principal determinant of that is the structure of the financial sector. Now, in the 1980s, Vietnam attempted to open up its central planning and it went badly wrong. And they ended up having to encourage the private sector into the financial sector, into the financial system. So half the financial system, half the banking system is essentially private sector. And the result of that is that there's been competition for capital and returns on capital and a price on capital. So in the 30 years we've been at work, there's only been 2 years when interest rates, let's say deposit rates, have been negative in real terms. So every year, apart from 28 out of 30 years, you put your money in the bank and you've been paid more than inflation. Now, that's a tremendous point of discipline. It means that there is a price of capital and a price for capital, and companies need to earn a return on their cost of capital in order to be profitable. So this systemic stability, partly political, partly through coincidence, partly through history, is in marked contrast, for example, with China, where 28 out of the last 30 years, you put your money in the bank, you get a negative return because deposit rates have always been lower than inflation in China. And that's because the state controls the banking system and is able to determine the cost of capital. So there's a very big difference between China and Vietnam in that sense. And that's partly why companies have decent ROEs. We've had a pretty poor year for the past 2 years for corporate earnings, actually, partly an overspill of COVID. And ROEs are down to sort of 14, 15%. But typically, companies' returns on equity are 15 to 20%. This is high returns on capital. What are other aspects out there? For me, climate is an issue. Much of the world is getting hotter and wetter and less predictable, including, of course, where we are right now. But Vietnam is a country that is likely to suffer some of the challenges of climate change. We live on the edge of the Mekong Delta, which I think it is the largest or second largest rice growing delta in the world. And it's enormously productive because Vietnam is a huge rice exporter itself. But you're beginning to see the impact of climate change, salination of water, unpredictable rainfalls, etc. So, that's an area we keep a close eye on.
Finally then, Dominic, perhaps we can just talk a little bit about the trust itself now. As you said, you've got a continuation vote coming up in 2025, which is helping to keep you awake at night. There are actually 3 investment trusts invest in Vietnam. And I think it's fair to say that certainly more recently, your performance record has been slightly inferior to the others, and you have a wider discount at about 20% at the moment. So what can you do about that?
Yeah, absolutely. Good point. So let's just pick up on that. There are 3 trusts listed in London. There's one, Vietnam Holdings, which is, small and perfectly formed, one might say. But it's had a good track record. Smaller fund, easier to invest, probably. I think there are questions over the long-term viability of that as a trust. I don't want to speak for them or against them. They're friends. We're all friends. We all know each other. But it's
quite small. It is definitely
quite small. Yeah. So that leaves really 2 big trusts, VOF, Vietnam Opportunities Fund, and ourselves. The principal difference between the 2 is that VOF has a mandate that specifically includes private markets. So this means that they're investing in private businesses. And that's not a discipline we have within Dragon. We are all about public markets. We believe very strongly that investments need to be valued transparently, and investors need to be able to see through the portfolio, to be able to see the metrics, to see what things are earning at. So that's in terms of mandate. We have had a couple of years of ropey performance. That is indeed true. The reason for that, I think, is during COVID, when markets globally went all over the shop, we ended up with some, I would call them, less considered position sizes. We had some overweights in companies that perhaps were a little bit ambitious. I think that there's also another factor, which is that Vietnam's markets have performed pretty poorly in the last 2 years. And the reason for that is that Vietnamese public companies have not grown their profits. So I think there's an objective and a subjective reason for it. We can't really tackle the objective one. Safe to say that our forecasts for earnings this year are in this 16 to 18% profit increase range. And that's after we've seriously stress tested our analysts on their views. So a recovery year after 2 years of flatlining. But internally, we've definitely been able to be subjective. So we've evolved on the investment team. Broadly speaking, there's a new lead portfolio manager, who now heads a team of 4 managing Vale, up from 3, 2 DPMs and an assistant. And we've also evolved our investment process. The previous CIO has moved to chair the investment committee. We've got a new CIO who's a Vietnamese PhD, been with the firm for many, many years. And within our investment process, we've tightened up a lot of the areas that we thought perhaps needed to be tightening. So I've mentioned position sizing. That's one, both on the overweight size and the underweight size, without, of course, abandoning our strong belief in active management, which in a place like Vietnam is sort of unavoidable, I think, because of the volatility and the developing nature of the markets. We need to be active rather than passive. So we have pronounced active share ratios, although these are regularly monitored, both at the portfolio level and the company level. So risk management in regards to returns, I think is, if I look at our mandates, 2022 was not good for Dragon. 2023, we put some serious factors to work, and the gap between our benchmarks and what we're supposed to do has all but evaporated. Vale, as you rightly point out, is still slightly below the benchmark, but it's closing the gap. And all other mandates that we run have closed the gap. So I'm cautiously optimistic. And of course, with the pressure of a continuation vote, the months ahead are going to be quite intense. I don't want to say anything that's not in the public domain, but just on the discount front, both VOF and Vale trade at around the 20% discount levels. In fact, VOF is a slightly bigger discount because it has a higher proportion of private assets, and I think you would expect that. But in both cases, I think boards of funds are not comfortable with discounts this level. And of course, as you know better than me, the trust sector as a whole is suffering some major issues. But the proximate cause appears to be a lack of natural investor interest, a lack of flow, if you like. And so we're spending a great deal of time looking at what structural aspects we can bring to bear to encourage investor interest. So within the UK, of course, the key broad theme here is making ourselves understood to wealth management platforms and to individual investors, as well as keeping in very regular touch with there's 100 institutions who are shareholders in Vale, which is up from about 20 when we listed in 2016. So that's the London aspect. But there are considerations of listing on other exchanges. There are considerations of things like tokenization. And I stress these are not yet matters of policy, but we are clearly considering and discussing these throughout this year. So I think by the time we get towards the end of the year, we'll be in position of better performance, commendable performance. We'll be armed with a bit of an agenda of relevance-making points to put to shareholders as we head towards the continuation vote in 2025.
And of course, hoping that indeed Vietnam might get upgraded to emerging market status.
Indeed, that would be a happy coincidence indeed, Jonathan. Yeah.
Very good. So that was Dominic Scriven, who is the chairman of Dragon Capital, the advisor to the Vietnam Enterprise Investment Trust, ticker Vale, speaking to me this week. My next port of call was to talk to Ian Lance, who has been co-manager of the Temple Bar Investment Trust since November 2020. Took over the mandate there following the departure of the former manager, a well-known deep value investor. And since then, your timing was good, and the performance of the trust has been pretty reasonable since then. But we're really going to talk about the UK equity market. You've been making some comments about that. We talked about a year ago on the podcast. And since then, well, if I can put it this way, there's a gloom about the UK equity market, both the structural factors that may be holding it back and the fact that valuations are very low and so on. That's still very much the kind of flavour of the month, is it not?
It absolutely is, Jonathan, yes. I think any UK equity fund manager has probably had the same few charts in his deck for about 3 years now, showing how cheap the UK is, particularly relative to the US market. And the trouble is nothing has really changed in a year. It's just remained cheap. But we think we can now see some quite interesting catalysts for the realisation of the value. So hopefully we'll get on to discussing that.
Indeed. So just to put some context around this, I looked you up this morning, and the kind of share price total return over 1 year anyway is about 7.8%, something like that, I think. But of course, the US market has done a bit better than that. So that's very much, as you say, the forefront of people's thinking. Because behind this, there is a kind of structural issue, isn't there? It's the fact that many of the traditional buyers of investment trusts, and particularly UK equity investment trusts, pension funds and wealth managers, have basically been selling for several years. And I think that's probably going to be one of the catalysts we're going to talk about, is what can be done to change that. But that has been your experience as well, hasn't it?
Totally. I mean, there are different dimensions to this. One is pension funds, and that's been going on for decades, hasn't it? I was a pension fund manager back at a firm called Gartmore in the 1990s, and balanced pension funds used to have about 60% of their portfolio in UK equities. That's not 60% of the UK equities, that's 60% of the total portfolio. And today that figure is roughly 3. So pension funds have spent about 3 decades just selling down, going sort of equity bonds, active, passive, and UK global. So that's been one feature. The second one, I think we both know, don't we? There's been massive consolidation within the UK wealth management industry. And as those firms have got bigger and bigger and bigger, again, they have moved towards centralized models for asset allocation. And typically that's been involved going away from a regional model to a global model. And that will very much be driven off benchmarks. So the benchmarks today, believe it or not, the US market is over 70% of MSCI World, whereas the UK is about 3% of MSCI World. So again, you can see why there have been sort of loads of flows out of the UK and into the US. The final thing that I will say is that in some ways this selling is good. And what I mean by that is Nick and I will often refer to this as valuation agnostic selling. So in other words, people have taken a business decision that they are going to sell UK equities and they are going to buy US equities. And that's as far as the sort of decision goes. They don't actually look at the relative valuations of those two asset classes. And so we end up in this situation where, as we know, UK equities are 50-year lows relative to US equities, and yet people are still selling the UK to buy the US. And in some ways that is good, because what that means is that if you are an active manager, it creates opportunities for you because it drives share prices down significantly below their intrinsic value.
But of course, there is this looking rather quaint now academic theory that markets are efficient and that therefore capital should flow in the direction of the higher prospective returns adjusted for risk and so on. That isn't happening, is it? So these other bigger trends so far have just kind of swamped all that. And the UK market just gets cheaper and cheaper, as you say.
Yes. Actually, let me just make one final point, which is that the point is if you are an active manager, you can make good returns, even in the UK equity market. And you mentioned earlier on that Nick and I took over Temple Bar in November 2020. Since the time that we took it over, it's up 110% versus 55% for the UK market. So if you are someone who is able to, I suppose, access these levels of undervaluation, there is money to be made irrespective of the sort of wider trends.
Right. Well, before we come on to that, just to make one other point, Temple Bar, you've got a market cap, I think, around 700 million, something like that. And that, as far as you're concerned, is still of interest to wealth managers and so on. Have you suffered outflows from wealth managers because of these trends you were talking about?
Not really. Probably not outflows, but maybe less inflows than one might have expected, given the performance that I just described. Because I think if you are one of these massive wealth managers now who are running sort of multi-hundred billion type portfolios for their clients, investment trusts in general present you with a liquidity problem, don't they? When your asset allocation committee changes its mind and it wants to move money from, one asset class to another, doing that via investment trust is quite difficult. And so typically those people will use either open-ended funds, or in a lot of cases, actually, they'll create their own segregated portfolios so that they can move money around more efficiently. No, the only money out that we've seen actually has been the discounters. Actually, when the discount came in, we saw a little bit of selling. And then as the discount recently came out, it stopped.
Right. And the discount is, remind us about the board's approach to the discount. Currently, you're trading around 8%, and it has been a little bit wider, as you say.
Yeah.
But there's no formal policy, is there?
No, there isn't a formal policy, but our broker has been buying back shares as the discount went out. And as the discount stabilised, as you say, around the 8 at the moment. And so actually the share buyback has diminished in recent weeks.
And obviously you trade as a UK equity income trust, and we're in an era of higher interest rates. That normally is quite positive for the value style, I think. But what kind of yield are you offering at the moment? I'm guessing somewhere sort of just around 4% or maybe just south of 4%.
It's just a little bit over 4%, yeah.
Well, looking ahead now, you've made some points about the general situation, but let's look at the opportunities in the UK equity market. You've made a couple of points that there are things which are going on at the moment which are helping, or may help, in the short term at least, not in the long term maybe. One of those is the amount of M&A. A year ago we talked about the possibility there are going to be lots of M&A in the UK because things were so cheap. And we have actually seen a lot of deals, have we not?
Yes, we have. So I was looking at some data from Peel Hunt recently. Over the last decade, there have been roughly 40 takeovers of UK companies per annum. Last year, that jumped to 64. And this year, the run rate is higher than that. I mean, this year, it's quite remarkable, actually. You know, we're only mid-April at the moment. We've had 3 companies bid for already this year. And so the first one was Currys, which obviously was bid for. Second one was Direct Line. And literally in the last day or so, obviously, we've had IDS, which is the old Royal Mail, bid for. And in the background, there have been loads of other bids of companies that we're not involved in. So my conclusion from this is that the valuation of UK equities has got so low, and don't forget, it's also low in what is probably quite a cheap currency at the moment, that it's attracting the interest of overseas corporates. I think overseas corporates are looking at the valuations of some of these things and they just almost can't believe their luck.
And that's obviously not good for us as a market in the longer term. It's not always true, but I mean, unlike private equity takeovers, these things aren't necessarily going to come back, are they?
I agree. It's a really difficult one, this one, because to a certain extent, I suppose it's affirmation of our view that these companies are cheap. And of course, we get a big jump up in the share prices, which helps performance in the short term. There are 2 things that worry me. The first one is that a lot of these share prices have been so depressed for so long that one could see shareholders accepting takeovers at levels that actually don't reflect the full value of the company, because people get that pop in the share price and they just think, thank goodness for that, and they'll just sell something, and you end up selling things too cheaply. So that concerns me. And the second one is the longer term issue that I think you've just alluded to, which is the fact the shrinking UK equity market. You know, we are not having lots of new companies coming onto the market to offset these companies going off the market. And if this trend continues for the next sort of 5 to 10 years, then the UK equity market will just continue to shrink. So short term, it's potentially a positive, but yeah, long term, I think it's an issue.
Do you have a particular position on some of these ideas for reforms that people have been talking about now for a few months? It has at least kind of bubbled to the surface a little bit that maybe as one of the world's largest economies, we really need a thriving UK equity market. And it's not necessarily helpful the way we structure things. I mean, do you have a view that there's too much regulation, or obviously it'd be nice to get rid of stamp duty and things like that, but where do you stand on that, and what would be the most helpful reforms you could see happening?
Yes, I do. I mean, I absolutely agree with your premise that I think to be a successful economy, it helps if you've got a flourishing stock market that is, you know, going to allocate capital efficiently. And I don't think we've got that at the moment. And I think if trends continue like this, it's only going to get worse. So I do think that the government needs to take steps, whichever government we end up with. Needs to take steps, and some of the things that people have been talking about, such as getting rid of stamp duty, I think would be positive. Another thing which I read just this morning actually was someone actually had a table of the percentage of domestic equities held by pension funds in various countries. And the UK sits right at the bottom. So in lots of other countries, domestic pension funds will hold 30, 40%, something like that, of their own domestic equity market. And the UK is sort of 3%, as I said earlier. So that seems anomalous to me. Why is it that UK pension funds hold such a low level? I don't totally know what the answer to that is. But it strikes me that that is the sort of thing that could move the dial, actually, because if instead of holding 3, they held 5 or 10, that's a significant amount of money that would go into UK equities. Whereas things like the British ISA, I don't really see that moving the needle.
No. Well, I guess one argument you could make is that the pension funds basically are also become valuation indifferent, if you like, in the sense that not a liability matching and so on. It's a different approach, which is driven in ultimately by regulation, and you could change that regulation, I guess. That would be one option. The other trend, of course, we've seen a number of companies move to list in other markets. That's another trend that we've seen some signs of. And if, say, as some people have suggested, Shell comes along to you and says we're going to move our listing from London to the US, how would you react to that?
Again, this is a really tricky one because probably they make that move, the share price goes up, I would think. But again, in the long term, it just creates a headache for us because Temple Bar is allowed to hold 30% in non-UK equities. And we are basically at that 30%. So if all these companies start disappearing off from London to New York or wherever it is, lots of them won't be able to invest in them. So again, a bit like takeovers, you probably get a short-term pop in the share price. But long term, it just creates more headaches for you.
Let's talk about share buybacks then. This is one of the things that companies can do when their valuations have fallen to very low relative levels. We are seeing that happen, I think, in a number of cases. You've highlighted one or two. Tell us about that. And are you, again, uniformly in favour of that as the use of companies' spare cash?
Yes. Okay, so let's discuss that. Funnily enough, it's not just us who've been quite depressed about the low levels of UK equity share prices. It's the people who run the companies. So obviously we meet with lots of the CEOs of the companies that we invest in. And by and large, they are quite depressed people at the moment because they feel like they are doing a very good job in terms of running the company and the profits are growing and they're sort of happy with that. And then they look at their share price, which has done nothing but go down for probably 3 years and is sitting there on a price earnings ratio of 5 and a dividend yield of 8. And they sort of look at us and say, what on earth is going on here? And we just have to say to them, look, don't take it personally. Unfortunately, it is this valuation agnostic selling which is going on. But then we say to them, look, rather than get frustrated about it, use it to your own advantage. And what we mean by that is I'm paraphrasing an expression from Warren Buffett, but he basically said when a business is trading a significant discount to its intrinsic value, no capital allocation decision can add more value than buying your own shares back. And we wholeheartedly believe in that. And that's the message we've been given to CEOs for the last couple of years. And it does appear that that message is starting to filter through to people because, again, we have data showing that roughly 50% of UK companies have bought back their own stock in the last 12 months. That is significantly higher than recent years. And it is also now the highest of any market in the world. So UK companies are buying back their stock aggressively. And as I say, it does appear that that message has filtered through. Now, I suppose to answer the last part of your question is it universally positive? No, we don't think share buybacks are always a positive. If you are a company with a lot of debt, you should not be buying your shares back. You should be paying down your debt. You should be focusing on growing the business, your capital expenditure, before you buy back shares. But lots of our companies, they are actually in the right position where they've got strong balance sheets, they're generating a lot of cash, their shares are trading very, very lowly. And in those circumstances, we do think that share buybacks add significant value.
Right, and you hold up as an example, like many people do, the example of Next, which has been a fabulously successful company, but has always followed a very rigorous capital allocation policy, has been buying back shares to an extraordinary extent, really.
You're absolutely right. So Simon Wolfson, who is the CEO of Next, he has a very, very clear policy. When his shares are lowly valued, he basically turns on the share buyback mechanism. And believe it or not, over the last 23 years, he has reduced his share count by 2/3. So there's only a third of the shares in issue that there were back in 2000. And of course, mathematically, that has a positive impact on the earnings per share and the dividends per share, doesn't it, when you reduce the share count by that amount. Another company that we talk about, which actually we don't hold Next anymore, and we don't hold this company, which is British American Tobacco. Again, this is just a fabulous example of how powerful share buybacks can be. In 2000, which I'm sure you remember, Jonathan, a little bit like today, everyone was obsessed with technology shares and there was no valuation too high for technology shares. And conversely, there was no valuation too low for what were dubbed old economy shares. And so British American Tobacco back in 2000, the share price was £3. Roll forward to 2015, the share price is £50. That is a 24% per annum total return across that 15-year period. And what's amazing about that is that their sales grew by 2%. So they turned a 2% sales growth into a 24% per annum total return for their shareholders across 15 years. How? A little bit of it was taking costs out, margins going up, etc., etc. But it's yet another business which generates lots of cash, very lowly valued shares, and you basically just put that cash to use by buying back your own shares and reducing your share count. So I think people often obsess too much about top line growth, and they probably underestimate the power of well carried out share buybacks.
Yes, I guess, and that also talks a little bit about incentives. You say you talk to managers all the time. Obviously, it's important that the incentives are right to make sure that they do the right thing. In the old days, business leaders always wanted to grow their company. That was the way they thought. They wanted to expand. They wanted to buy other companies and so on. At the moment, though, they've got to be much more attuned to the return to shareholders than they were. You're suggesting that is actually happening now.
Yeah, totally. I think it's almost just a sort of simple case of the maths that, when your shares are as lowly valued as some of these companies are, it's exceptionally hard for a CEO to justify an acquisition because two reasons. Number one, he or she is normally paying a big premium. So he's probably actually buying expensive shares. And number two, of course, it's significantly more risky, isn't it? When you buy back your own shares, you probably have a better view than anyone else on the value of the business. So that is a very low risk transaction. When you go and acquire another company, you are taking a significant risk, aren't you? Because as much as you might think you've done your due diligence, you don't really know until this company becomes part of your business how it's going to integrate and how it's going to perform and so on and so forth. So I think in this environment, it's become very, very hard for most CEOs to justify big acquisitions when they could just buy back their own shares and create value that way.
I mean, one of the other issues around the UK market has always been its sectoral makeup. And inevitably, as a fund manager like you are, your performance is measured against the benchmark. And the benchmark is full still of oil companies, banks and pharmaceutical companies. They still dominate. Yes. And as a result, your portfolio has to reflect that as well. That's a bit of a headwind, isn't it not? Because there may be reasons why these sectors are not producing as good returns as some other in the world. And obviously technology, we know, is where the Americans have been very strong. So do you feel that is a constraint? I mean, if you didn't have to keep an eye on the benchmark, would you perhaps have a slightly different structural makeup in your portfolio?
No, not at all. I think it's a headwind that is about to become a tailwind. So going back to our conversation 2 minutes ago about British American Tobacco, as that share price set off from £3 to £50, don't forget NASDAQ was just about to lose 75% of its value over the next 2 years. So it's all about your start point. During the late 90s, not having a very tech-heavy index was definitely a headwind. And then all of a sudden, from 2000 onwards, actually having an index was based around energy and mining and tobacco and things like that actually became very positive. And I think we're in a similar situation today, actually. I think that probably as we look out the next 10 years, actually having an index which is not very heavily skewed to technology because of the starting valuations is going to be a good thing. And in actual fact, I think it's more likely that it's going to be areas like energy, mining, financials, all those sorts of old economy areas that are going to do better, actually.
Right. So if I asked you directly, why should I be looking at buying Temple Bar Investment Trust shares at the moment? Give me the shortest answer you can, consistent with being fully comprehensive at the same time.
Yes, okay. So the reason people should be buying Temple Bar at the moment is because the level of undervaluation of the shares that we own in the trust, Nick and I think, is probably the lowest that we've seen in our 30-odd years of running money. So the price-earnings ratio across the whole portfolio is 8. That is pretty much the lowest that we've seen in our entire lives. But it actually gets better than this. So going back to this conversation around sort of how companies can give you a great total return through share buybacks and dividends, some of the figures that we are looking at the moment are just extraordinary. So I'm just going to give you sort of a couple of examples. So if you take the oil companies like BP and Shell have generated around 40% of their market cap in earnings in the last 2 years. You've had nearly half of your market cap in earnings in the last 2 years. They've paid you about 10% as a dividend over that 2-year period. They bought back nearly 20%. So you're sort of close to 30% of the market cap coming back to you as a shareholder in just 2 years. But the winner here is NatWest. So NatWest has generated, again, 40% of its market cap in earnings in the last 2 years. Paid you back 14% as dividends and bought back 30% of its shares in 2 years. So you've had nearly a 45% total return from dividends and share buybacks. Mathematically, if those companies carry on paying you dividends and buying back their shares at that sort of rate for the next couple of years, it's almost impossible. It's extremely unlikely, isn't it, that the share price is just going to sit where they are, because the PE will just go down and down and down, and the dividend yield will just go up and up and up until they reach ridiculous levels. So I suppose that's why we are so excited about the opportunities that we're seeing today. And of course, not only are you getting to buy those companies, if you buy Temple Bar, you're going to buy those companies at an 8% discount. So that's the pitch for Temple Bar at the moment.
So that was Ian Lance, the co-manager of the Temple Bar Investment Trust, talking to me about the UK equity market, a subject we keep returning to because it's looked cheap for a long time, and as he said, it's stayed cheap for a long time. But maybe there's something in the wind going on here.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.